Boys, welcome to the second instalment of Mr. Palmer's screencast. This one will involve the goods and services tax, or the GST. Since its introduction in July 2000, essentially what it means is that a consumer tax of 10% of anything that's purchased, apart from a few items, including fresh food, you charge 10% tax basically on that transaction. Now, the government doesn't actually collect that tax until the end of the quarter, where a business needs to complete a BAS statement and then basically pass that money on that they've essentially collected on behalf of the government. So all GST must be recorded in a new ledger account called the GST clearing account. This is probably the most important thing that we need to remember about GST, is that it works basically the exact opposite to the way you think it would work. So the money that we've received, okay, through our revenue, essentially, through the collection of our revenue, is actually a GST liability. So that means that we need to pay that GST onto the government. Okay. So what we're hoping for is that, because we're going to be selling, or our selling prices are usually higher than our cost prices, or we're hoping so, most cases GST on sales is going to be greater than GST on the purchases that we've made. So we're hoping that at the end of the 3 months, we're going to have a GST liability that we need to pass on, because that means that we have essentially received more money than we have paid out. There may be some cases, however, where, for example, a business has made a bulk order, as we can see here, bulk order of stock, or we've purchased a really expensive non-current asset, for example, a piece of equipment or something like that. The GST on purchases will be greater than the GST on sales. And basically that means that the business will hold a current asset of GST, which means that basically the Australian Tax Office will owe the business that amount of GST, or they will get a GST refund. So we'll need to just quickly knock those review questions over 4.1. That will essentially give you the basis for just the note taking that we would have done in class. Now, I don't want to get too bogged down in source documents. Look, we all know that what source documents are, and I suppose in the real world, we're not going to be getting lists of transactions, are we? We're going to get, we might even just get a box that's full of source documents that we need to work out. We might have a receipt book, and more than likely we're going to have a receipt book for the money that we've got coming in, and some sort of check butt or bank transaction listing for the transactions going out. So there are, I suppose, a couple of there's a little bit of information here about source documents in the GST. Actually, I might get rid of that. So basically, a source document needs to include these things if it's going to be used for GST purposes, and that's why basically you see the words tax invoice, you see the ABN number on invoices, I suppose, in your daily sort of purchasing. What we're going to go to now is just calculating the GST. Quite a simple process. Basically, you got 2 ways of doing it. If you've been given the sales price, it's really, really easy. You just add 10% to the selling price. This is added to the selling price, obviously, to give you the total price. So it's just selling times 10%. If you've been given the price, or for example, if you've been given a source document that says, or you've been given a transaction that says $385 including GST, the easiest way to do that is you just divide the price by 11. Okay, so we've got that. So it might be necessary to work backwards from the total price. So either GST, which is 1/11th, or the GST, the total price divided by 11, or the selling price can be determined in this way as well. At this point, I reckon we can have a crack at review questions 4.2. Just a really good idea to start getting into the habit of being able to answer these questions about referring to qualitative characteristics or referring to accounting concepts and principles. And yeah, look, so I think we'll knock those over. Okay, so moving on to calculate or accounting for the GST with cash sales or cash inflows. So the most important thing that we need to remember here, boys, is that at the time a cash sale is made, oh, I'll get the highlighter here. This needs to be written down. At the time that the cash sale is made, the business will receive the cash for the goods plus the GST on the sale. And this must be documented on the cash receipt. Okay? So what we need to do is we need to account for the GST at the time of sale. That's important. So we account for the GST at the time of sale. That's basically what this is talking about here. And this is basically how we do it here. Okay, so we've got, this is the area that we're looking here. So essentially we've now got 5 transactions. So we've got the transaction with the bank, so the cash coming in. Then we've got the cash sale, which is essentially the revenue. We've got the cost of sales, so that's the decrease or the expensing of the stock. And then we've got the reduction in the asset of the stock control. Then we've got the GST that we're accounting for, which, as you can see, is this one here. So moving on from there, we can just see here how it would look in the ledger. So that's all that is doing, is just basically taking that list that we were having a look at before and putting all those transactions into the ledger. That's all that is. Now this table here is an interesting one. So this is the effect on the accounting equation. Just have a quick look at that. So notice that the GST clearing is actually an increase. This has actually come through, obviously, as an increase in the GST clearing liability. So that increases the liability by 40, which means that obviously if everything needs to be in balance, assets is going to equal 190. So owner's equity and liabilities added together needs to equal 190, which obviously it does here. Okay, important note here that if we're accounting for the GST at the time of sale, we don't need to account for it when we are receiving a debtor. Okay, so if a debtor is paying us, so say for example, a debtor has purchased something on credit say 3 weeks ago, and then he comes in and says, I want to pay $1,000 off that bill that I owe, we don't account for that GST. That GST has already been accounted for. However, that GST does contribute to the amount that he or she owes us. Okay, so if the sale price for the goods that were purchased on credit is $1,000, then what the debtor owes us is $1,100. It's not just the sales price. Hopefully that makes sense. If it doesn't, just let me know tomorrow morning, and I'll explain it a little bit further. The other couple of the other couple of receipts that we may see that don't have GST involved is interest revenue, obviously capital contributions, and any time a loan is paid directly into the account. Okay, so GST on cash payments is pretty similar to GST on cash receipts. So at the time the cash payment is made, okay, that's when we need to record the GST. Okay, so at the time the cash payment is made, the business will pay cash for whatever it is, plus the GST on the purchase. I suppose the other important thing with this is that the GST does not contribute to the value of whatever we're purchasing. So if we purchase $1,000 worth of stock, okay, we have a GST liability of $100. That stock is not worth that stock is not worth $1,100. The value of that stock is $1,000, and the GST is $100. And here's basically how you account for that, as we discussed. So we've got the amount here that has hit the bank of $1,320, and then we've got insurance, which is obviously we're paying an expense here. Insurance of $1,200, GST clearing of $120, which is 10% of $1,200, and this is how it would look in the ledger. And just to finish off, let's just have a look on how this affects the accounting equation. Okay, so we've got assets are only affected by $120, which is that decrease in GST clearing, because we've got $1,320 decrease in bank. That's how much we're paying out, and we've got a prepaid insurance asset of $1,200. And the payment of this expense at the moment, obviously, because it hasn't been fully expensed, it's still a prepaid insurance asset. There is no effect on the owner's equity. Okay, so just to clarify here, again, because we're going to deal with the GST at the time of purchase, payments to creditors are not subject to GST. And here are another a few types of transactions that aren't, again, subject to GST. So, boys, that brings us to the end of this screencast. What I'm going to get you to do is I'm going to get you to do review questions 1, 2, 3, and 4. I think that'll probably do us, and then we'll do some activities tomorrow morning. Thanks for your time.